Let's broaden out the conversation and welcome in my good friend Bill Lee, Chief Economist over at the Milken Institute. Nice to speak to you again, Bill. It's been a while. What did you make of Powell's comments on Friday? Because we've seen this sort of post-Powell rally, and it seems like we're coming off a bit today as the market sort of wrap their head around it. We've also got the big catalyst, which is going to be the PCE on Friday. But what did you make of the messaging from Powell?
I think what's gone underreported is that not only did Powell change his mind, he changed his mind about how he's viewing inflation. He's starting to side with Waller and some of the doves and say, you know, that fear of tariff inflation that we have that may enlarge inflation expectations to be longer lasting than we think may not happen. And I'm willing to start to bet that we can actually move policy in advance of knowing exactly how that inflation is going to come about. And that's part of this new framework the Fed has put together that has really revised the way it's going to be doing business over the next 5 years. And that is really significant and hasn't been talked about enough.
Yeah, I mean, that's interesting. I suppose the elephant in the room, and he did very much highlight that, is going to be the tariffs and, you know, what sort of impact that's going to have to the upside risk to inflation. I mean, you know, as far as what the markets took away from what he had to say, I mean, there's still, you know, growing bets for a September rate cut. I mean, some believe that we could be one and done. Some believe we could be looking at 2, potentially even 3 cuts. But I suppose it all just comes down to, you know, how hot that inflation gets.
Well, it's not just how hot the inflation gets, it's sort of the qualitative nature of that inflation. I think Chair Powell is expecting that a lot of the service sector inflation will continue, and that's been the main source of inflation in the United States. Let's remind everybody that the U.S. is a relatively closed economy. The U.S. consumer basket is 70% domestically produced services and only 30% import, 30% goods. And of the 30% goods, about 25–30% of those are imported. So the base on which the tariffs will be acting is going to be fairly small. And what Chair Powell is very deadly afraid of is that people are so rattled now by expectations of tariff inflation that any little spike that we see will start to cause people to think, wow, this could continue even longer than we think, or it might be bigger than we think later on. And I think that's the source of uncertainty that Chair Powell was worried about. But he was very clear in Jackson Hole when he said, look, I think it will be temporary and we can start to adjust policies to worry about employment. And he even said, by the way, we're not going to be looking at employment the way we used to, that, you know, equilibrium employment is between 4 and 4.5%. And if it starts to get out of that range, we're going to start worrying about changing policy one way or the other. He said, because the labor supply and immigration policies have changed so much, we're not sure where labor supply and labor demand actually is falling. And we may actually act if we think that other indicators are showing that labor market's either too tight or too loose, even if we are beyond the ranges. So we could have 4.2% unemployment, and he might think, wow, the things are actually weaker than we think, and actually lower policy, even though the unemployment rate has not risen to, say, 4.5 or 5%, which the traditional way of doing business would have had them do.
Yeah, the fact that he seemingly paid more attention to the job side of the dual mandate on Friday has seemed to get the markets, you know, off to the races as far as, you know, not as much emphasis on the price stability as we've heard Powell talk about in the past. So that very much has been key. But, you know, now we've had time to digest all these comments. I've just been going through, you know, some of the analyst notes. I mean, you have a note out from Bank of America, for instance, saying the Fed is perhaps risking a policy mistake. There are signs the economy is accelerating. Labor weakness could rebound. And, you know, I was listening to Jim Bianco as well earlier this morning, who was suggesting that, you know, what if the labor market does turn out not to be as bad as some think? You know, particularly when you look at the yields, which have sort of gone in the opposite direction to how they normally, or one would expect them to go, particularly the last time we saw the start of rate cuts.
Well, Sam, as you know, we card-carrying members of the dismal science are, especially on Wall Street, are paid to be dire and to warn about terrible consequences. You hardly hear anyone say, by the way, the investment incentives that President Trump put in place, along with the bargaining with tariffs and getting a lot of the investment dollars to come into the United States, might be creating a lot of jobs. And the higher salaries associated with those jobs will be real productivity. And so we won't worry about those being inflationary. So those are the kind of warnings that I think you don't read much about, because it's much easier when you're, as I remember when I was chief U.S. economist at Citibank, it's much easier to say, things could really go bad and you better be worried about it. And by the way, talk to our salesman and he'll show you how to worry about it, as opposed to, gee, things might be better than they think and you should continue doing what you're doing.